Hello everybody. Welcome to my talk on IBNR and RBNS models in multi-state life insurance. So for those not familiar, IBNR here refers to incurred but not reported claims, while RBNS are reported but not settled claims. So you will notice that I'm not actually doing mortality modeling. I'm doing something that works a bit more generally. So for any multi-state models, you will be able to use these methods that I present here. So you could include disability states or marriage status or free policy conversion or all these things. The methods would still work. So yeah, and this is, as you heard, joint work with Kristian Buchardt he was in PFA pension but is now in AP pension, but also with Kristian from the University of Copenhagen. And if you're interested in any of this that I will present today, there is a paper in the Scandinavian Actuarial Journal that was published here the 1st of March this year. So this is the overview of the presentation, and if you have some good eyesight, you might be able to follow along with the agenda on the top of the slides. So to begin speaking about these extensions to classic multi-state model setup, I'll first have to introduce what do I mean when I say the classic multi-state model setup. So in this case, you usually assume that you have some stochastic process, which we call the state process x of t. So x of t is the value of x at time t, and this process then models when different insurance events occur. So for example, when you become disabled or when you die or something else. And the classical example here is that of a Markov chain. Then this state process here generates some information, which we represent with this filtration fx of t. So this is the information that you would have if you observed x fully on the interval from 0 to t. Furthermore, you have what's called accumulated payments. So here, b of t are the payments generated by x on the interval 0 to t. And these have a special property that they are specified in the insurance contract. So when you look at the contract, it says, okay, you have to pay this if the person becomes disabled, you have to pay this if he is alive at some future point in time. So another way to say this is that B has this special property that it is incrementally adapted to X. So the payments that fall between time S and time T here only depends on what happens to the state process here in this interval S to T. And now finally, the most fundamental object in this setup is the prospective reserve here, and it's defined as the expected discounted future cash flow, where you condition on the information that is generated by your state process X. So, however, so this is very well known, but what we're working on are situations where it's not reasonable to assume that you have access to this filtration here. And this is usually because there will be some reporting and processing delays of information. And hence, when you do not have this filtration, then you're not able to actually compute this conditional expectation that is your reserve. So you have to do something else. And this is basically what I will present today. It's basically to kind of go more in depth in what do I mean with these reporting delays and where did this happen, and then outline what mathematical approach have we taken to address this, and briefly also sketch some of the results that we obtain. Okay, so throughout the presentation, I will use this simple example of a total permanent disability insurance. So this is a insurance that pays a disability sum when you become disabled. So you might model this with the following multi-state model. So you have this state process X here, which takes values in the active state, disabled state, and dead state. And note that we don't model death after disability, since there are no payments strictly after entering the disabled state, because, well, we specify the cash flow like so. So there is some premium rate pi here while you are in the active state, and then if you transition to the disabled state at some point, you are paid this sum of B. So how do we actually observe this process? Well, as actuaries, we know that we observe processes through records in some different databases, maybe SQL or Excel or whatever. More generally, we will think of these databases as what's called temporal databases. So these are databases where there are two distinct time axes. The first time axis is called the valid time. So this is concerned with when the events occurred. So this is also called historical information. But you also have the second time axis, which is called transaction time. And this tells you when the different informations were observed by you, the insurer. So generally, you can represent it like this. You have some observation here, for example, that a person became disabled. And this is then valid in some period. So he is disabled from some date to some other date. But also, this information is entered in the database at a certain time, but it might be superseded at a later time if we obtain some new information. For example, that for some reason he was not actually disabled, he didn't live up to the criteria we had for the disability payout. So instead of looking at tables, I will kind of show some examples here with a timeline that's maybe a bit more visual. So let's here take one insured, and we say that he can maybe be in some different states. So you can have no reported disability claim, you can have reported a disability, you can be disabled, and you can be active. And then also certain events can occur. There can be a disability occurrence. We can award the disability report, or we can reject the report. So now we take this one insured here, and we start in the situation here in the beginning where he has not reported anything. So we think that he is active, and yeah, he has not reported anything. So what then happens is that at a later time here, where the color changes from light gray to dark gray, right here, he reports that he actually became disabled at the time point here that I marked with the yellow star. And then a little time goes by, and then the insurance company ends up rejecting this claim, saying that, okay, you do not live up to the criteria needed to get this disability payout. And then a long time goes by where the insurance company does not hear anything back from the insured. But then eventually he returns and says no, he still claims that he actually became disabled here at the time marked by the yellow star, but now he has maybe gathered some more information from his doctors, which has the effect that this time we end up awarding the disability. And now it's important to note that so far, in valid time, this insured has simply been active throughout this entire period because we have not awarded him this disability sum yet. But now this changes retroactively, such that in valid time now, he's actually only been active here until the time marked by the yellow star, and then he has been disabled ever since. So two important things to note here with these different time axes is that in valid time, this information is subject to change retroactively because you might get some new information later that changes how you thought events happened. While this is not the case for transaction times, their time is always moving forward. Secondly, it might be important to note that the time axis in transaction time is much more complicated than the simple one for the valid time process. So the central question is now, what should we actually reserve when we are in these different situations? Because we have some observed states here that there is no report and that there is a reported disability and so on. And these differ from the usual model states in our multi-state models, namely that a person is active or disabled or dead. And also, can we even use all this developed theory, use all this literature that is on prospective reserves, or do we have to go back to square one and do something completely different? So basically, our answer to this is that what you should do is that you should derive so-called IBNR and RBNS models for your multi-state models so that you can incorporate these information lags. Quickly taking a step back, the fundamental challenge here, which is different from what happens in non-life insurance, is that the contractual payments you have here are valid time objects, so they are specified in the insurance contract according to when stuff happens to the insured, so you get something paid out if you become disabled. But the data that you have are transaction time objects. They are concerned with what you actually observe as the insurer. So you have to somehow link these time axes in some way. Now, there are two possible approaches in how to do this. So the first, maybe most natural approach is you try to keep this information that you have about how B depends on your state process in your models. But then what you need to do is then now you need to model the distribution of your state process conditional on the actually observed information. And this requires new methods. While another approach 2 here, would be to simply say, okay, forget all about how this payment process B depends on the state process, and then you could use, for example, non-life insurance methods, maybe a chain ladder, which kind of does not need this information. So we think generally that approach 1 should lead to better models, both more powerful and more explanatory, for several reasons. So the first, most obvious reason is that you incorporate more structure in your model that is a priori known to be true. So you don't really need to waste data learning structure that you knew was there already. Also, the state process is very nice. It has some objective meaning, so it might be easier to choose a good parametric model, whereas if you do non-life insurance, it's sometimes a bit less obvious how you should choose a good parametric model for example, the payment sizes. Also, you should be able to better handle these intertemporal dependencies there are in life insurance and disability insurance payments, that if I'm disabled at some future time point, I'm probably also disabled a little time after that, and you are able to capture this with these models, whereas with the chain ladder, you would have to have a very long runoff in order for your models to be able to capture this. And finally, we would also like to use more of this established multi-state life insurance literature that is concerned with all this, instead of simply going back to using more non-life insurance methods. So this is what we have done, pursued this approach number 1. Okay, so basically the program of our research and of our paper is the following. So you introduce what we call an observed state process and observed payments. And then, as in the classic multi-state model, you then define the corresponding present value and corresponding reserve. And then lastly, we link these new reserve objects to the classic objects in order to find out how they differ. So basically, you get a table like this. So in the first column should be all the objects that you are used to. You have the state process here, x of s, which is the value of x at time s. But now you get a corresponding version in transaction time here, xts. So, and this should be read as the value that x takes at time s, but based on the information that you have at time t. And this continues down. So you have a payment process here in valid time, which is the one that would be generated if you knew the x process, but in transaction time, you might pay out something different. So these are the observed payments in real time. And then you define the present values as the discounted future cash flows. You have some different informations in the two models, and then you define the reserves as the conditional expectations of these present values given the corresponding information. So now briefly on to the results that we obtain. So we get some nice theoretical structure results here. So just for notational convenience, we will quickly assume that there is no interest rate. And basically the only assumption you need for this to work is that the following structure assumption that your transaction time state process here agrees with your valid time state process when you let the transaction time go to infinity. So another way to say this is basically that your valid time state process is the finalized timeline of your transaction time state process. And then you get the following nice result that the present value in transaction time is the same as in valid time, but plus a correction term here, which is the difference between the payments that you would have paid out had you known x in the interval 0 to t, and then the payments that you actually have paid out. So this is very natural somehow, but it has the consequence that there are some differences between the classic reserves and the reserve that you actually should use if you do this transaction time modeling. So you should also here in transaction time reserve to these previously wrongly settled payments. And for your reserve, you should also condition on the information you actually observe instead of, for example, that he is active at a certain time, because you might not know this. So unfortunately, this simple relation between the present values does not generally transfer to a simple relation between the reserves. And this is basically because we have not imposed any structure on how this observed information would affect how we think that the state process has moved through time, only that they should agree all the way out at time infinity. So you need to impose a bit more structure in order to get some close results here. But for the simple example that we had of a total permanent disability insurance, you get some nice intuitive results. So here are the IBNR and RBNS reserves. So let's start with the IBNR. It might look a bit complicated, but let's take it one step at a time. So the reserve is composed of some different terms. So you have to integrate over all the previous time points. And for each of these time points, you need to calculate the probability that the person became disabled at this prior time point S. So this is given by the disability intensity mu AIS ds. But for the IBNI reserve, you only need to reserve for those who have not yet reported their disability. Otherwise, you would use the RBNS reserve or something different. So you have to multiply with this probability that you have still not reported your disability, even if you became disabled here at time S. And for each of these people, you should simply reserve the disability sum of B. So very intuitive, hopefully. Also for the RBNS reserve, you get a quite simple expression, namely that this reported claim that you have to scale the disability sum here with the probability that this claim is awarded, given the information you have at your current date. So of course, this is only for a very simple example, but you are able to get some very similar results here for much more complicated and realistic products. Finally, so now some new, so you're used to kind of estimate these intensities, but now some new objects have appeared here in your reserves. So you have these different probabilities, the probability that the disability has not been reported, given that it happened at some time, and then the probability that the claim is reported, given your information. So you need to estimate these new objects in order to be able to use these reserves. So very briefly, here's kind of the idea on how to do this. So we'll let the time where we do the analysis be given by this little c, which is some positive time. And then in order to estimate what we call the IBNR factor, which is basically this probability, we first note that if the process is stationary, then this is just the same as saying that the delay exceeds the time difference here, t minus s. And then we can estimate this probability. So this is just given by the distribution of the delays. So we need to estimate this, but we have some IID delays here. But we should be careful here. They are right truncated at this time, c minus the disability time. So delay I is right truncated at this time. And this is because you only observe the delays where the disability time plus the delay is smaller than the time point where you do your analysis. But you can take care of this in your likelihood. Also, to estimate the RBNS factor, there are many possible choices on how to do this. One possible approach is to use logistic regression, so this gives you a probability, but you have to take care of the fact that this is right-censored. When you do your analysis, there will be some claims where you don't know if they will be awarded or rejected. So in order to take care of this, you could use pseudo-observations, but there are many other options here. And then finally, you actually also need to estimate your intensities, and this also becomes a bit different when you are in this setup where there are both IBNR and RBNS effects in the data. But the main take-home message in how to adjust your methods is the following. So if you have your occurrence exposure rates, they should be modified by using this RBNS factor. So if you have a reported claim at the time of analysis, you should scale this with the probability that it is awarded. So let's say that's 70%. So instead of incorporating the full occurrence in your OE rates, you would incorporate just the 0.7. Pretty easy. Also, you have to scale with this IBNR factor, actually the inverse. So you multiply the exposure with this IBNR factor. So maybe this is also quite intuitive. So where the RBNS effect was kind of to reduce the OE rates, here the IBNR helps you make the ratio larger. And this is because when you are close to the time of analysis, you should expect that you will see very few jumps, because you only see the jumps that are reported in time. So you have to scale up the observed ratio in order to get the actual ratio that you're interested in. And it turns out that this is more or less simply just by multiplying here the exposure with the IBNR factors. That was all for me. Thank you very much for your attention, and I look forward to hearing your questions.